Before we get into the presentation, though, I'd like to remind listeners today that we will be making forward-looking statements, and we ask that you refer to the slide on the screen here for appropriate disclaimer language. In addition, this language can be found, of course, on our investment presentation on our website. Listeners are also reminded that we will be providing clarity on past announcements, on the progress of our business, commercialization, and market catalysts. It will be done in the context of what we have previously disclosed in news releases and in our quarterly MD&A. We cannot discuss any material information or advancements that have not been previously publicly announced, and that's because we are a public company and subject to regulations that strictly prohibit selective disclosure in limited forums such as this AGM. As you all know, we are further restricted by non-disclosure agreements that we have in place with investors, funders, potential partners, governments, customers. These are important relationships to us, and the mutual trust we have built there is golden. So we are very careful about guarding that information close to our chest. So please keep this in mind as we take in the presentation and as we proceed with the question and answer period. I'm going to quickly introduce Alex Holmes here to my right, who is the Chief Operating Officer for Nano One, and Carlo Valente, who is the Chief Financial Officer, and you've also met Anthony C. virtually in the AGM portion of the meeting. We're all available here to take questions and answers. Alex and Anthony will be participating in the presentation, and then we're all available for Q&A after that. So let's dive right into it. What I wanted to do here for shareholders is really present the problem and the solution first. So cathodes sit right in the middle of mining, refining, processing of the critical minerals into functional materials. So cathode is a functional material made of a whole bunch of critical minerals that is assembled into lithium-ion battery cells, packs, and ultimately their final application like a vehicle or an energy storage unit. The challenge is that all of those materials go through the cathodes, and the big challenge is that China controls a great deal of the refining, processing, and transformation of those critical minerals into cathode and ultimately anode materials as well. If we look at what China's advantages are and how they've come to achieve this, it's a very big deal. They control about 99% of the world's LFP, probably 80 to 90% of the world's batteries. It's actually quite a phenomenal achievement. And for LFP, it's because they have abundant low-cost sources of iron sulfate, and that's in tailings that exist in China that don't exist anywhere else in the world. It gives them a big advantage. They have laxer regulations on sulfate handling and wastewater. Again, that gives them a cost advantage and a volume advantage over other players in jurisdictions around the world. And this is really where Nano One comes in. It's our one-pot technology specifically applied to lithium iron phosphate, LFP, that helps to address this problem. So Nano One, we're innovating, and we're not trying to replicate China. And I think that's really, really key here, because it's very difficult to copy what's going on in China and be cost competitive, environmentally competitive, energy competitive. We have to be thinking out of the box as nations in order to compete with the formidable assets that China has in their backyard. So first, on the raw material side of things, we are actively qualifying sources of iron and lithium that are in our backyard with partnerships like Rio Tinto and many other suppliers. And by doing that, we are able to eliminate the bottleneck. We do that by avoiding iron sulfate. We go directly from iron metal powders, either as an oxide or a metallic form. And that enables us to leapfrog what the supply chains that are established in China. We have eliminated all of the wastewater and sulfate. And so that gives us a competitive advantage over the more energy and environmentally intensive processes that are used in China today, and ultimately presents a plant or a manufacturing solution that is easier to permit in not only in Canada and the US, but in most Western countries around the world. China also has succeeded by vertically integrating in the supply chain, because that drives down costs by integrating mining and refining and processing into clusters. They've been able to drive down costs and benefit from the economies of scale. Our answer to that is to integrate the precursor manufacturing steps and the cathode steps. So the precursor step is where you mix the lithium, iron, and phosphorus into a precursor, or in the case of NMC, that would be mixing nickel, manganese, and cobalt, processing them into a composite material that would then typically go to a cathode producer who would mix it with lithium to make the final cathode material. We combine those in what we call the one-pot process, and that drives down cost, energy, and water usage, and it helps us to eliminate the wastewater and sulfate mentioned in the previous points. Ultimately, easier to permit and competitive with the solutions that with the technology that exists in China today. I mentioned economies of scale. That's a super important part of what's going on today globally. China has managed to industrialize cathode materials and batteries to a level not seen anywhere else in the world today, literally in the millions of tons of cathode materials, and that gives them very large capacity and an ability to compete on cost and price that has a tremendous influence on the market today. Our answer to that is what we call our design one, build many strategy. It's a modular plant design that is only enabled by the fact that we eliminate wastewater. By eliminating wastewater, by eliminating sulfate, we eliminate all of the custom engineering that goes with a typical PCAM plant, and that drives down the cost. It drives down the permitting risk, it drives down scheduling uncertainty, and ultimately allows our plant to be deployed more quickly and scaled more rapidly than the conventional processes used in China. And China also benefits from widespread industrial know-how. They've been at this longer, they've got a big head start on the rest of the world, and that's a fundamental advantage and a barrier to entry to many around the world. We answer that by acquiring a facility in Quebec, as most of the listeners know here. That's in our Candiac facility. It's an operating LFP facility. It's the only one of its kind outside of Asia. It has been operating for 10 years. We acquired the facility. We decommissioned all the wastewater handling, all the sulfate handling, and we recommissioned it again with our one-pot process. And we are in the stage right now where we are sending materials and demonstrating the equipment to our partners and to our potential customers and licensees for the future. Ultimately, though, it's not just about the plant, it's about the expertise, because there is no shortcut to becoming an expert in this space. You only get it through practice. The team in Quebec has been making LFP since 2002. That team is still intact and in place. And although small by any standard in Korea, Japan, or China, it is still the only team and the most experienced team outside of those jurisdictions. And that provides us a tremendous advantage moving forward, because we can build off of that without having to go through these steep learning curves and make the kind of mistakes that one would make if you didn't have that experience. The learning curve is an important part of the advantage, and that's what we bring to the table. And then lastly, or actually not lastly, another point is that China has developed a lot of low-cost equipment. As they've industrialized cathode production and battery production, they've also industrialized all the equipment that goes into making these plants. And so the cost of that equipment is coming down, and that also puts pressure on the rest of the world to try and match that. So look, we have access to the same equipment, not only in China, but in jurisdictions like Korea and Japan and other areas in Southeast Asia that can provide similarly competitive pricing. And with really a global view to procurement and equipment sourcing, we can basically negate that particular competitive advantage. And we're working closely with our partners to establish a good supply of equipment. It's going to vary. North Americans, Europeans, Asians are all going to look to have equipment in different areas. In some cases, they'll want to pay more because it will come with greater warranty and greater support. In some cases, they'll look to drive down costs, the lowest cost equipment. We have access really to the same supply chain of equipment, and that's a really important thing to understand. And then lastly, China actually quite recently put export controls on their process technology. This is for LFP, lithium, and other materials. What's important to understand here is China, as I mentioned above, China has developed a tremendous amount of know-how, not just intellectual property and patents, but just fundamental know-how. How do you make these materials? How do you get that plant up and running and get it up to full capacity as quick as possible? Those are really important things when you start building the plant, because if you don't get that plant up and operating at 95% capacity, then you're going to be carrying debt, you're going to be carrying all kinds of sort of financial instruments that will weigh on the company. So getting up to full capacity, using basically leveraging the investment that you've made in that plant becomes a really important part of success in this industry. And China is exporting, basically they're putting controls on the very best of that process technology, the very best of that know-how, because they've got a fundamental lead on the world, and they're trying to prevent that lead from spreading to the rest of the world, essentially. And that's what these technology controls are about. We, Nano One, have technology independence from that. And that's because we've got 48 patents so far issued and granted around the world. Those are in jurisdictions like China, Japan, Korea, Taiwan, India, US, Canada, and in the European area. We continue to invent, of course. It's a fundamental part of our value proposition. And we have 50 patents worldwide today. We have at least 50 more patents in prosecution in jurisdictions around the world. So that gives us the energy, basically the technology independence, but also having that expertise in place in Quebec, like I described before, is fundamental to us owning the technology and owning the process and owning the know-how without having to rely on other parties for it. And that is a big part of the value proposition that we bring to the table. So I'm going to hand the next slide over to my colleague Alex here. Alex, if you can advance the slides with the buttons there.
Thank you, Dan. Yeah. I think I'll fast forward with the animations and just start talking. So, Dan obviously addressed the bottlenecks to manufacturing LFP outside of China with a simple copy and paste approach and how we're bringing a solution. I'd like to dive a little bit deeper into that and specifically cover how our solutions will support our customers, how we're going to help them get to market faster, smarter, and with less capital at risk. So today, every new plant goes through bespoke engineering exercise through a series of studies before an investment decision can be made. This can easily take 2 to 3 years. Add a year or so for permitting, 2 years to build, and 6 months to commission. And only then, once that plant is operational, can that supplier then go through the final qualification step. And then they basically sit on the plant idle for 3 to 6 months, waiting for the customer to qualify them in the final step. So there's a lot of working capital tied up in that timeline. Along the way, feedstocks also need to be qualified, and that takes at least 12 months. So we're looking at 6 to 7 years before cash flow. It's not very attractive when you think about it compared to a number of other industries, but it's the business, and the demand growth profile is very significant. So we have deep-pocketed companies that are playing in this field. So we identified this challenge a number of years ago. And so we challenged ourselves to start thinking outside the box. How can we offer a much faster solution? And right around the same time, Worley, our partner in our alliance, started hearing about the pain points from their customers, timelines to markets, costs, waste streams, all of the factors that we know our technology can provide, and as our investors. And so by partnering with Worley, we develop or are developing what we call a CAM package. And so this allows a customer to license a feasibility level production line. So that saves about 3 years in engineering and considerable money. And, we all know how much customers love to pay for engineering hours. So we also look at all the key equipment vendors and we pre-qualify them. So we save customers months of procurement, engineering, lead time, vendor qualification, and again, engineering hours. And then by working with the raw materials feedstocks and pre-qualifying them through Candiac, we also save about 12 months. So our solution essentially is ready for the customer's preferred engineering firm to then pick it up, do the engineering outside the production line, and rapidly advance it to a final investment decision. So we think this could save customers at least 3 years on their path to market and a lot of money. And we feel this is a very tangible value proposition. By modularizing the plants, we also help bring down CapEx and OpEx. It allows more rapid capacity expansions as companies enter their first phase and start thinking about their second phase. With a modular design, they can much more rapidly deploy. And it allows the equipment vendors that are supplying these plants to produce more of the same equipment more often, which gives them scale, which brings down costs. So today we demonstrate the technology in Candiac. That's a key value proposition our facility holds. And it's access to decades of LFP manufacturing know-how. We can support large volume offtake for our licensee strategy. And that's so the customers can get their purchase orders that they need to then be able to make an investment decision for a plant. We think this shaves about 18 months off of the customer qualification cycle by being able to do this for them. And they also don't need to build a pilot plant, which further saves them money. We also have training support as part of this for their plant managers, their senior operators. So this helps mitigate that startup and commissioning risk. And it also helps ensure operational efficiency. As Dan alluded to, people need to get to high yields to ensure operational efficiency. This is where our know-how and our background and our ability to train people in a demonstration facility brings significant value. And then access to that know-how and continuous improvement is we're finding that's becoming more and more valuable to the different customers we talk to. And the reason for that is because when we speak to them, they're starting to face technology access restrictions from China in the form of know-how. And we are not encumbered by that restriction. So in summary, I just want to wrap up. There's a number of different value props that we think we're offering. So outside of the technology itself, it's time and money savings, large offtake support. We help customers get to market more rapidly, and we streamline their capacity expansions. And they also get access to the most experienced LFP manufacturing team outside of Asia. So these are in addition to our technology advantages. And as a package, we think it's a very enticing offering. I'll also speak a little bit about our catalysts in motion. Maybe we could put them all up on the screen. So we laid these catalysts out at the start of 2025 in various public filings. And we want to zero in on two key themes today that we feel are critically important. So one is balance sheet resilience. And the second is the path to sales and, of course, ultimately cash flow. So first, on the balance sheet resilience side, we've been able to, we will continue to be extremely focused on this. It's very important from our perspective as we navigate our path to first sales and then positive cash flows. It's probably obvious to many listeners that the capital markets and the battery space as a whole have been extremely challenging for the past 18 months. As hype has faded, timelines were pushed, projects canceled, and companies failed. We've managed to secure over 60 million in non-dilutive capital in the past several months. We bought Candiac for 10 million and we flipped it for 20, while keeping all the important pieces to execute on our business plan. We secured over 40 million in government grants and long-term 10-year interest-free loan. This covers up to 75% in some instances of our CapEx and OpEx over the next 2.5 years. Of this, we've received about 13 million a year in the bank, and we have about another 29 million left to draw. And we are targeting some quarterly and some semi-annual reimbursements for those different government programs. We ended Q1 with about 28 million in cash in the bank and are burning about 2 to 2.5 million a month. So we've secured our runway through 2025 without issuing a single share. This is a big accomplishment. On the path to sales, we have a dual track revenue model as we've been communicating to our various stakeholders. So one is direct sales from Candiac, and the second is for smaller volumes of ESS and defense contracts. And the second is licensing for production royalties and upfront fees for much larger volume contracts. So it's a long road to scale first of a kind technology. And we are sending iterative samples to customers. We get feedback, we tweak, we resample, all on the path to validating for a sale. The LFP product in the market today has improved the past couple of years, all in China. And so we're also needing to keep pace with those changes while scaling. We're hitting what we consider an ESS LFP product today in commercial intent equipment. This is a big advantage over not just producing something in a lab. And we're working towards our high-end EV LFP product. Fortunately, we have the team depth, the asset base, the partners, and we have working very collaboratively with the right cell manufacturers to get there. So we are targeting direct sales initially off the presently installed 200-ton per annum capacity in Candiac before we transition to the expanded capacity volumes when we make the investment decision to 1,000 tons plus. We're completing an engineering study on that expansion now, and we anticipate completing that in Q2 of this year, and then making an investment decision in 2025. And we're taking this approach as a prudent method of project execution. We could wing it, but that seldom turns out well. We've seen that happen. And so we value being disciplined with our capital allocation. A lot of the expansion within Candiac is largely due to automation equipment. So piping and raw materials handling and what have you. But we already have the key pieces of commercial equipment in place to make LFP with the one-pot technology. And so we're running trials in that commercial production intent equipment today, and we're also sampling out of our 200-ton per annum installed capacity. The expansion is supported by our government programs. I think that's important to mention because I think there's some shareholder questions around that, and so we wanted to offer some clarity on that. The other thing we want to say is, it isn't lost on us. Investors really want to see first sale and a first license, and we do too, of course. So we're laser focused and getting this all across the line. We will say that we are being selective about the different parties that we speak with, and we really are focusing on the established players. There's a lot of noise, and it's really important that we focus on the ones that are serious about what they're doing. And so you won't find us forecasting sales and timing until it's definitive and it's binding. So when we announce an LOI in the future sales, we will be doing that because we know that we've checked a lot of the technology and product boxes, and the customer is advancing towards a definitive purchase order. On the sampling side, we're sampling with a number of direct customers today. It's iterative, it's gone underway for some time, and we're making good progress. On the larger volume targets with longer sales cycles, we are also sampling there. We're in the room with the right targets, and we're active in the discussion preparing for future deployment of our licensing model. In order for our licensing sales to be successful, we need to complete a feasibility study, or an FEL3, to assemble the balance of the CAM package. So we're happy to say the FEL3 is well underway. We anticipate completing that in Q4 this year, and that's something that Worley is taking on, working collaboratively with our engineering team in Burnaby and in Candiac, Quebec. The balance of the CAM package, of course, includes those pre-qualified equipment vendors. So there's active discussions going on, as Dan alluded to, speaking both to North American, European vendors, as well as different vendors in Asia, Korea, China, and Japan, so that customers have an option in terms of the path they would like to proceed with on the CapEx front. On the license strategy front, it's flexible. So our customers can work directly with Nano One for a license only, or they can purchase a CAM package with the technology embedded within it, the key equipment, and also have the support of Worley's technology solutions team to help them de-risk their investment. We'd like to mention that we're in discussions with target licensing customers in several regions around the world: South Asia, Japan, Korea, Morocco, the US, and the EU. With the automotive end customer discussions, they're all looking for local supply. They are going to first go with currently installed capacity for first supplier for a risk management reasons, risk profile reasons. And this is China's supply, it's clear. But rapidly following that first supply, and I mean immediately following, they want local supply and diversification, as one country reliance is not acceptable for their procurement teams and strategies. And so these discussions happen now for supply needs a few years out, and decisions are needed well ahead of production needs. Dan will talk about this a little in terms of where the market's going, but there's a projected incremental 4.5 million tons of LFP demand coming in the next 10 years. 99% of that's made in China today. We believe our actions in the past few years, our execution to date, and our ongoing customer engagement activities are leading towards solid outcomes. Not always as quick as we'd like, admittedly, but evolving into stronger and stronger opportunities, and we're confident they'll bear fruit with time. So, we feel it's important to say we have not missed the boat. The strategic partners we have, the credibility we've built deep inside these large organizations and inside the automotive companies are all leading us towards fulfilling our vision. Thank you.
Yeah, thanks, Alex, for a very comprehensive look at our catalysts and how we're moving forward. I want to spend just maybe a minute here really just on a little bit of historical context. I think it's important for everyone to understand. Many of you have heard this before, but look, LFP was invented in the mid-90s at University of Texas, but it wasn't until the late 1990s that someone figured out how to carbon coat it and actually make it actually work in a lithium-ion battery. And that happened in Quebec. And then the first license happened in Quebec. And then the first 600 tons happened in Quebec. And then one of the very first cathode plants in the world happened in Quebec. And that's all ended up in Candiac, and that's all the team that now exists under the umbrella of Nano One. And but it's also important to recognize that a lot of that know-how and technology ultimately spilled into China, and it grew organically in China to the place that I described before. It's very, very large volumes there. And that is the landscape that we live in. But here in Canada, particularly in Quebec, there is a long history of process innovation, supply chain innovation, and ultimately the know-how to bring this forward, not only to the automotive industry, but also to the battery energy storage industry, for wind, for solar, for AI-driven data centers. It's all going to become fundamentally important. And then I want to focus also a little bit on history. I think Alex kind of went through this in some detail, but it's important to know that this journey didn't start last year for us. Really, the decision to move to LFP, we recognized back in kind of 2020 timeframe that we saw issues and challenges in the NMC market, and we saw an opportunity with lithium iron phosphate. It was starting to grow in China. We could see that really clearly. We could very clearly see that it was the lowest cost, it was the safest, it was the longest lasting of cathode materials. But we could also see that the improvements coming at the battery and the battery pack level were going to make it cost competitive with NMC. It was going to start to eat market share that NMC had gained. And that was fundamental to the strategy decision we made back in kind of 2021 to launch a more concerted effort at building out our LFP footprint. So we made a bid in December of 2021 to buy the Candiac facility in Quebec from Johnson Matthey. We got to the agreement 6 months later, and then another 6 months later, we closed the deal. In the middle of all that, we brought Rio Tinto in as an investor, $12.5 million Canadian, roughly covering the cost of what it cost us to buy Candiac. Just so everyone knows, Candiac, that facility was built for $75 million Canadian, or sorry, US, in 2014. We bought it for 10 million Canadian, and Rio Tinto came in with really the balance of those funds. And that happened at a point in Nano One's history when we had a valuation of about $300 million. So Rio Tinto recognized value in the company at that point and really drove this forward. That was followed by $10 million grant from STTC, Sustainable Development Technology Canada, which is now part of NRC, National Research Council. There was $17 million from Sumitomo Metal Mining. Sumitomo Metal Mining is the most fully is the most vertically integrated mining company in the battery space today. They not only have they been mining copper and other base metals since way back in the 450 years ago, but they also have built the precursor and cathode business that supplies Panasonic and ultimately Tesla's vehicles. They've been at it for a long time, and they're a very, very reputable partner, and we enjoy pretty much weekly discussions with their team to drive forward and meet the requirements of their customers, not only in Japan, but increasingly in jurisdictions around the world. We brought the Warrior Alliance to the table last year. Alex walked you through that in great detail. I'm not going to spend any more time on that, but it's a massive value proposition for us from the licensing perspective. And we've seen a number of grants and loans come into play. Alex described a few of them. This is from a next generation, or what's called NGen, Next Generation Manufacturing, a Canadian granting agency, but also the Department of Defense, that's the Pentagon in the US, the Quebec government. That land that we bought way back in December 2021, we were able to sell a portion of the land we weren't using and sell the land and building that we are now currently housed in for a total of about $20 million Canadian. We still have, of course, the team. We still own all the equipment. We still own the plant. That's an extremely important part of our process going forward. But we have managed to put roughly $60 million of non-dilutive capital into the company in the last 9 months. Very important. So I'm going to just spend a couple minutes here on market forecasts before I hand it over to Anthony for sort of closing remarks, and then we can move to the Q&A. But listen, this is how the market, this is how analysts were thinking about the market back in 2021. They were projecting that in 2025, LFP would have roughly 25% of the market, and the rest would be going to NMC and other chemistries. That would be roughly about just over a terawatt of energy, basically of batteries being made. However, last year, they have actually adjusted those forecasts, and surprisingly, they have not gone down, they've gone up. This market is better than ever right now. The 2025 forecasts are roughly 25% higher in total than they were imagining in 2021. And the LFP numbers have gone up considerably. Before we kind of dive into the specifics of those numbers, I want to just translate what 5.9 terawatt hours actually means. That's roughly 100 million electric vehicles. And that's enough battery to drive basically to power the Canadian population, and that's businesses, that's people, that's industry for 4 days. Just to give it context of how much battery and storage capacity is in 5.9 terawatt hours. So these recent forecasts, and this is from BNEF, these recent forecasts are about 3 times higher for LFP now than they were 4 years ago. And if we break that down, that's 2.4 times more LFP for electric vehicles, and it is a stunningly 7.6 more batteries and LFP for battery energy storage systems, and that's because the emergence of AI and data centers and energy storage for wind and renewables has become a very important strategic asset around the world, and batteries play a fundamental role in that. NMC doesn't really address those markets. It simply doesn't have the safety and the long-lasting ability that LFP has. LFP has become a dominant player in that. We saw that many years ago, and that's why we chose to put more and more focus on the LFP. So I'm going to stop here. I'm going to let Anthony has has spent a lot of time traveling around the world. He spent a lot of time in China, in Korea, and Japan. He knows this market really well, and I think he's got a lot to say on this. And I want to give him a chance to. I want to give shareholders here a chance to get to know Anthony and see what he kind of really brings to the table. Anthony, over to you.
Thank you, Dan. So with that, just to add some anecdotal commentary to some of the data points that Dan's mentioned so far. If we actually just look back at 2024, obviously most of the world, especially the Western world, tends to be predominantly focused in terms of the growth of battery demand being driven by electric vehicles. And, while last year reported a fairly strong year at approximately 25% growth, year on year, 2024 actually recorded an ESS growth in demand at twice of that level. I believe that the number was probably closer to somewhere between 50 to 55%. That's important to note because, just to put it in perspective, the size of the ESS market today is approximately the same size as where the EV market was no less than probably approximately 3 years ago. So the ESS market, as Dan pointed out, is growing due to a number of different end-use market segments, such as automated manufacturing, data centers, as well as kind of the more traditional renewable energy, and mainly essentially to allow for contingency and deplugging from the grid to the extent that those applications or those end market segments may encounter curtailment due to capacity limitation in grids around the world. What's also important to note in that ESS demand last year is that while China drove much of that growth with approximately 60% of overall demand growth from that, it was actually followed in second by the North American markets. The US probably represents over 30% of that. So the US market, while notwithstanding that, probably some of the headlines from EV sales have been quite lukewarm, I would say, in North America and to a certain extent Europe over the past year or two. ESS demand in other parts of the world, ex-China, has actually been growing very rapidly. The important thing to know about that ESS demand pie is that today over 90% of those deployments of ESS capacity is actually in the form of the LFP chemistry. And so you can see that as that market becomes increasingly larger, and I would point not only obviously, investors and shareholders can kind of take note from some BNEF commentary here, but some of you may know this other little Chinese battery company called CATL, which recently actually IPO'd in Hong Kong. And if you actually refer to the prospectus, which is actually publicly available, you would actually see that their end demand, not by 2035, but by 2030, is actually already in excess of the 5 terawatt hours here that you already see from BNEF. What's important in that is that out of that 5.1 terawatt hours by 2030, approximately 27% of that demand in batteries comes from ESS applications. So obviously you can see that if you look at the ESS share of where we are today, the cathode share of where we are today is roughly balanced between LFP and other chemistries. But it's quite evident that as ESS demand continues to grow in its share, the LFP share of the market will grow on a significantly outsized basis. And as Dan pointed out earlier, and Alex as well, there are many customers around the world who currently are essentially either deploying ESS systems and or building cells or building packs to make LFP batteries. And for the time being, they are either procuring cells and or materials from China in order to make those products. But over time, they would seek to diversify the availability of where they source those cells and where they source those materials from. And obviously that sets up Nano One very nicely in what I believe is a very interesting window of growth through the next 5 to 10 years. It's my own personal opinion that I don't think we have to wait until the end of the decade, sometime between 2030 to 2035. It would not surprise me to actually see the ESS market actually outstrip the electric vehicle market in terms of total demand by gigawatt hours or terawatt hours. And as I reiterate again, the more that the ESS market grows, then we're going to have outsized share of that market growing in terms of demand for LFP products. And along with that is obviously continued diversity or diversification of where those LFP products come from. So with that, thank you. And Dan, I'll hand it back to you.